Today, I'm going to talk about risk, net present value, the Capm model, and the security market line. We're going to talk about the net present value rule. I have an example I'll walk through, and then talk about how we use net present value to choose among projects based on these different things, such as the timing, short-term, long-term. We're then going to talk about diversification and portfolio risk, how to calculate portfolio risk, how individual securities affect that portfolio risk, diversification and the value additivity. Then we're going to talk about portfolio theory. So once we've talked about a portfolio and how it works, we're going to go in depth in portfolio theory, talk about the relationship between risk and return, the role of the capital asset pricing model, that was that Capm, and some alternative theories, other ways of coming up with that type of pricing. And then finally, we're going to have company and projects cost of capital, measuring the cost of equity, analyzing a project's risk, certainty equivalence. I'm going to talk about this other form that you can use to adjust for risk. Okay, so let's just start with the net present value. So the first rule, right? There's a bunch of rules around it. So the first rule is you discount the cash flows, not profits, right? Because we're thinking about the cash flow that's coming in. Remember, we have to have our capital expenses. We did that before, where we had an initial cost and then there was another capital expenditure later. And then, but just like you did in accounting, when we're getting our cash flow from the operations, we have to add back the depreciation, right? Because that's a non-cash write-off. Then we have to subtract off capital expenditure because obviously we're paying that out. And then working capital, that's, if you think back to the balance sheet, right, the short-term assets at the very top and the short-term liabilities, right, the difference in that is the working capital, the money that you just have available, right? So and so we're going to discount incremental cash flows, right? So you have to remember we're adding this one additional project. And so we had already had a conversation about opportunity costs, right? You have to remember that if you do one thing, it can preclude you from doing the other. So you have to include that. And I've said this a lot, but I will keep saying it, right? You have to forget sunk costs. That's just such a human nature thing to do. And so just be aware of that, right? And then at the very end, remember salvage value. That's really just saying we normally can sell back the equipment for some scrap or something. And so we have to remember that there could be this cash flow at the end, for that. We have to be consistent with our inflation, right? So we can use nominal interest rates and discount accordingly, or we can use real interest rates and discount accordingly. But you have to be consistent, right? You have to use nominal with nominal or real with real, right? And when I say nominal interest rates, that's when you open up the paper, right? And you see, whatever they say, the interest rates are, right? Nominal is the named, right? Nome, right? And real means, well, we subtract off inflation, and this is what it really was. So when people will change things into like, $2,020, right? And then they adjust those to those real dollars. And we just have to be consistent, right? We have to separate the investment and the financing decision. Because you have to remember that whether or not you do the project, right, that whether or not I invest in doing this is separate from, is this going to be from debt? Is this going to be from equity? Because that's going to be a decision made as part of our capital structure, right? If the project's a good project, then, you know, you should do that, right? So you got to remember to deduct taxes, right? Because we always want to deal with an after-tax cash flow. Right, and so here's the way to calculate the project's cash flow, right? Yeah, the cash flow from the investment, normally that's going to be negative, although there's a salvage at the end. You get any operating cash flow, and then the cash flow from the changes in working capital, right? So all of these, you know, is how we come up with those numbers when we were doing the net present value calculations on the calculator. So I said that this is good for a few different ways of addressing things. And so one could be an investment timing decision. And so what I'm saying in this is it better to sell today, or should I hold on for one more day? You know, will I be better off waiting until tomorrow? You know, and so what you do is you look at whatever these cash flows are and then discount them back. And then that would tell you whichever is the highest net present value is the one you would do. So in this case, there's all this timber. It's a, you know, so it's a bit to get out there. You know, you can imagine some large hillside or something covered with trees. So there's a increased cost, you know, this investment that's going to be required for you to build those roads, but the trees are also growing, right? But trees, you know, they grow really quickly, and then as they get larger, right, the same amount of mass is a smaller increase, right? Because as that diameter increases, it's not going to go up as fast to say double in area, right, of the cross section. So and so if you were to take those cash flows and discount it back using that 10% discount rate, you'll see like in year 4, the net present value was 68,000, right? Where in year 3 and year 5, it was 67,000, right? So year 4 would be the time to go in and do that. Okay. Another thing you can look at addressing is short-lived versus long-lived equipment, right? So is it better to buy the cheap equipment or the more expensive equipment, right? The one that's going to wear out faster, but it costs less, or have the longer one. And so in this particular case, right, this is the cost to operate the 2 machines, right? So machine A costs more, 15,000 up front, but if you see it lasts an extra year, and also it costs less to pay to operate that in those years, right? But machine B, right, it's cheaper up front. It does cost a bit more, and it doesn't last as long, right? And so the question is, you know, which one should you get, right? And you see, if you were to discount it at 6%, those cash flows, the present value of the machines, A is $28 and B is 21. Okay, so using that, right, we can then say, okay, well, if I had 28, you know, $1,370, right, for machine A, that's what that cost is. If I were to not pay that up front, right, and just you know, basically kind of like how you think of depreciation, right? And you break it up across the years, right? What would be the equivalent payment, right? That would happen over 3 years if it was, you know, the $28,370. And then you would do the same thing for machine B using the $21,000 value that you calculate for it. Okay, and remember, machine A is the more expensive one, but it lasts longer. Machine B is like the cheaper one, wears out faster, needs a bit more maintenance while it's running, but it was lower cost to buy up front, right? Oh, sorry. I'm sorry. So in this case, you would see the cost of running A is actually less, right? Because it's only $10, or I guess it's probably $10,000, per year, where the other one's going to be 11,000, right? If you take those all of those costs and scale it out across the life of the machine, which is what you do when you're like depreciating a machine. Okay. So, and this is a different take, right? So that was looking at two different machines, one, that's of the higher quality, and then one's a lower quality. This is, should I replace that machine or let it go a little bit longer, right? And so machine is going to produce $4,000 this year, $4,000 next year. By then it's probably done. But I could replace it now, and it would cost me 15,000, but I'm getting inflows of 8,000 a year for 3 years, right? So should I let the other one go out and, should I replace it now? Should I run it for 1 year and replace it, right? Like when is the optimal time? And so what we would do is just take those cash flows, right? You pay 15,000 up front, you're going to get 8,000 each year after that. The net present value of that is $6,000, right? If you were to put that as equivalent cash flows for each of the periods, you see there it's 2.387 thousand. Right, so that's what the cash flow of the new machine equivalent is, but we have the existing machine that's 4,000. And then another is to evaluate the cost of excess capacity. So whenever you're building a plant, you are going to make decisions about your fixed and variable costs, right? This is a topic that comes up often in like a microeconomics class, right? What's your fixed costs and then your variable costs, and so how many do you have to produce to break even, that type of thing. And so when you're building, you're out your factory, if you're not using it, you have all this idle machinery, this excess capacity, right? And so in this particular case, we have this computer system. It costs $500,000 to buy, right, and operate. And the discount rate is at 6%, and it lasts 5 years, right? You could do that same calculation, and you'd get an equivalent annual cost of $118,000, right? And so if you think about in year 4, like if you were to do the project then, the net present value of that today is $94,000. And so we start thinking of, okay, we overbuilt. How big of a deal is this, right? This is a way for us to put a dollar value on what that's costing. Okay. And so let me just move on then to diversification and portfolio risk. So just a couple of terms I want to talk about. So variance, right, is the square of the standard deviation, right? Or it's the square deviation, right, from the return, right? So if I calculate an average, say 6%, but the possibilities were 4, 6, and 8, right? I would say, how far is 4 from 6? That's 2, and then I would square it, right? How far is 6 from 6? It's 0, then I square it. How far is 6 from 8? That's -2, but then I square it. And so you add all those up, and that's your variance. If you take the square root of the variance, then you get the standard deviation. So I'll show you like an example with that. So this is an example just to calculate what that standard deviation, how we would get that, right? So you see there in column 1, the rate of return, right? So you get a rate of return 40% of 10% or -20. So like really good times, average times, and a recession. And then what's the expected return? You add those up, right? 40 plus 10 is 50, minus 20 is 30. And then divide by 3, because there's 3 of those. And so your expected return is the 10%, right? And so how far is 40 from 10 is 30. How far is 10 from 10? 0. How far is negative 20 from 10? It's negative 30. You square those. So you see in column 3, just square 30, 0, and negative 30. You have a probability of each of those. You multiply the probability times that squared deviation, add those up, and that is your variance, right? Take the square root of the variance, and that shouldn't be equals. It's actually a close, about 21. It's not exactly, but yeah, so the square root of the variance is the standard deviation. So once you calculate standard deviation, you have that variance. Okay, so how does diversification reduce risk? Knowing that we're going to measure risk as this standard deviation, what does it do, right? And so with diversification, what we're going to do is take the money and split it among a lot of various investments that hopefully are not perfectly related to each other, right? And within each of these, we're going to talk about the specific risk is what they use in the text. I've heard it also called idiosyncratic risk, right? But what that is risk that is with that firm, right? I chose to invest in this area of the country, and therefore this is the result, right? As opposed to the market risk, and this is just systemic, right? We're all going to be affected by this. I cannot use the market to diversify market risk, right? Like that's where the risk is, right? However, I can use the market to diversify your individual risk. Okay. Excuse me. So what does that look like? So this right here is the standard deviation of portfolios as you began adding more and more stocks, right? And if you notice, the line curves down, right? First it goes rather steeply, and then it starts to flatten out. And that's because of that systemic risk, right, that you can't get rid of, and then all those specific risks for each of the firms, right? So as you're adding more and more firms, because you are adding those firms, you are removing some of that risk, right? And the larger this portfolio, the more of that risk that's going away. Okay. Now we talk about the variance. There's also something called covariance, and this is how two things are related with each other, right? So we normally write this as what we call a variance covariance matrix, where these terms are the variances, okay, and these are covariances, right? So if I say, how does stock 1 and stock 1 relate to each other? That's the variance, right? The weight squared times the variance, right? And then that's true for stock 2, the weight of 2 squared times the variance, right? But when I look at 1 and 2 together, I got to take the weights and multiply them together, right? And then you see here, instead of saying like this sigma squared 1, we get this sigma 1, 2. Right? What is sigma 1, 2? What is this? We can break this is what that covariance is. This is how we write it. We write a sigma, and then you use a subscript for whatever it is. You could be S and B for stock and bond, whatever it is. This is 1 and 2, so 1 and 2. We can also rewrite that, break the sigma up as, the standard deviation of the 1, the standard deviation of the 2. That's where these are, right? And then how related they are. And this is the correlation, right? We had covariance, right, which was the sigma 1, 2, and then this is the correlation, right? How correlated are they? How, as one changes, how does the other change? It looks like a P, but that's a lowercase rho. It's a Greek letter. And so lowercase rho is between -1 and 1, right? If it's -1, that means they're perfectly negatively correlated. As one goes up, the other goes down, like pistons in a car, right? If you've ever seen like the cartoons and they show the pistons bouncing up and down, right? One goes up, the other goes down. That's -1. If it is 1, they move perfectly together like a weightlifter pushing up a barbell off their chest, right? They're pushing it up. They're both sides of the barbell are going to go up together, right? So it's going to be some number between there. A correlation of 0, right? Doesn't mean that there's no relationship. It means there's no linear relationship. But that's one of those things is basically like by knowing one, I really can't tell you anything about the other, right? So that's what that would mean. Okay, so I'm going to go through this example. It's going to be a little long, but hopefully it'll make sense as I do that. So suppose you invest 60% of your portfolio in Southwest Airlines and the remainder in Amazon. The expected dollar return on your Southwest investment is 15%. Amazon is 10%. What's the expected return, right? And we've done this before, right? It's the weight times the return for each of those, and you add them up. It'll be between 10 and 15, and of course, ours is 13%. Okay, but now we're going to add to that the standard deviation for returns was 26.6% for Amazon and 27.9% for Southwest, and assume a correlation coefficient of 1. That's that row, right? The correlation. And calculate the portfolio variance, right? So just taking those same numbers that we had, 60% for the weight and 40% for the weight for Amazon, right? And then they gave us the standard deviation, right? So I'm going to square that, the 27.9 and then the 26.6, right? And then that will give me the variance for Southwest and the variance for Amazon, right? And then for this covariance, right, it's the weight of one times the weight of the other, right? Southwest and Amazon, so 0.6 and 0.4, right? We've got this correlation term, right? They told us that is 1, right? And then we just multiply it, we don't square it, right? We just multiply them by each other, the 27.9 and the 26.6. And you notice these two are the same. That's always going to be true. Southwest changes with Amazon at the same way Amazon changes with Southwest, right? So that's why those two numbers are the same. These two will not normally be the same. And so putting that in the portfolio variance, right? We'll take the weight squared times the variance plus the weight of the other one squared times this variance plus 2 times the weight of the first one times the weight of the second one times that correlation term times the standard deviation of one, the standard deviation of the other. Where did this 2 come from? It's because I remember I said those two, the upper right and the lower left boxes were the same. So there's 2 of those. That's why there's a 2 there, right? So it's the portfolio variance is the variance of Amazon, the variance of Southwest, and then the covariance between them. Right? You get that portfolio variance, take the square root, and that would give you the standard deviation, right? Okay. And so using that, right, that's if it's 1, right? This right here, there's no benefit to your portfolio if you make it with a correlation coefficient of 1, right? The variance is the highest it can be in that case. Okay, because remember this term goes between -1 and 1, right? So 1 is the greatest value it can be. So now we're seeing what the highest standard deviation of this portfolio would be. Okay, what if we were to make instead of 1 only 0.26? If you put a 0.26 there, now the standard deviation is going to drop to 22, where before it was 27.4, right? So that's that correlation coefficient. You want that to be the smallest number possible. And in fact, what if you make it -1, the other extreme, you see the standard deviation drops to 6.1, right? This is extreme, right? Because you're able to build the perfect portfolio, with something that's has a correlation coefficient of -1, right? And so this is just to show how that standard deviation can really plummet. Okay, and so these are like the equations around that with the portfolio. So the return on the portfolio is the weight times the return for each of the investments added together. And the portfolio variance is the weight squared times the variance of 1 plus the weight squared of the variance of 2 plus 2 times the weight of 1 times the weight of 2, right? Times that row and then each of the standard deviations, right? And I know you may be looking at this and say, hey, that looks kind of weird. There's like a pattern there. It's like x squared plus 2xy plus y squared. It's not exactly that, but it looks similar. And yes, it does. And that's what you're thinking. You are correct. It's a square, but it's a square from using that matrix, right? And so when you do matrix algebra, it comes out like this. So, but yeah, so that's how we calculate the return for the portfolio, expected return, and then the variance of the portfolio. So let's look at another example, right? So we have a couple of stocks that we're going to look at, ABC and BIG. We've got their standard deviation, we've got their investment in the portfolio, we have their average return, and we have a correlation coefficient, right? If we, based on the weighted average, right, of the standard deviation, it would be 33.6, right? But of the portfolio, it's actually going to be only 28.1. If we put that in and calculate it, we see that, right? But if it had been, just the weighted average of the two, if the correlation was 1, basically, then that it would have been 33.6, right? So that's how we would calculate the standard deviation for this portfolio, and then for the return, we just have the weights times the average return, right? And that would be the expected return for our portfolio. Okay. Let's see. Oh, okay. Yeah. So you see the standard deviation of the portfolio, and then the expected return of the portfolio, right? And so the correlation coefficient, what if it were to be 0.3 instead of 0.4, right? You see that the standard deviation is lower, and the return itself is actually higher, right? Because it was 17.4, now it's 18.2. It was a 28.1 standard deviation, now it's 23.43, right? And it's because since they're less related to each other, my portfolio gives me more of a diversification benefit. Okay. And now we're going to talk about beta. And to talk about beta, we got to first introduce market risk, right? And so if I were to build a portfolio and take all assets in our economy, right? And that would be the market, and holding that is what we would call the market portfolio. Now, we don't strictly have that, but we have some things that are so broad, right? They're touching all areas. They're treated as such. It's sort of like that. We don't actually ever have infinities, but we use it sometimes because it simplifies, right? And so once we have that market portfolio, we can look at your returns and how it's related to that market portfolio. And then that relationship is the beta. Okay. And so here's an example using Amazon stock, right? For every 1% change in the market, right, Amazon stock gets an average return of 1.47. So we would say that the beta for Amazon is 1.47. There's other ways of calculating it, but this is the way we're going to use. Okay. And then you remember how we looked before at how securities, adding them to your portfolio would reduce your risk because it gets rid of those individual risks, but that market risk is still there, right? Well, if you look at beta, right, since that's relative to the market, if a beta is only 0.5, then the amount of market risk that I can't get rid of is only half as much, right? And if the beta is 1.5, right, I have even more risk than the market. And so I'm bearing more risk than just the market portfolio, right? And so even though you're diversifying away your risk, that beta itself is still going to show, in that way. Okay. And so when we write out beta, what we're saying is, how does this change with the market divided by how noisy is the market itself, right? So it's the covariance term, how we had just talked about covariance between our portfolio and the market, or the investment in the market, divided by the variance of the market. Okay. And so starting from this, right, Harry Markowitz came up with portfolio theory, right? And said, look, if I go out there and I take these various stocks, I put them together, because there is this correlation between them, right? The level of risk that I'm going to have, right, is going to be less than if there was perfect correlation between them, right? So as long as we have that correlation coefficient, we can do that, right? And we would say that by taking that, we're able to come up with a set of efficient portfolios. And when we're saying efficient, what we're saying is you cannot do better, in the sense that all you're doing is trading risk for reward, right? And so let me show you graphically what we mean, right? And so this was our portfolio, this Southwest and Amazon, right? And you see this blue curve, right? Now, if they're perfectly correlated with rho is equal to 1, then you see this dashed yellow line these are the portfolios we can make. We can go 100% Amazon, we can go 100% Southwest, or we can go anywhere in between, right? If rho is -1, it's this red one, right? And I can actually create a portfolio that would be risk-free, because those two are moving perfectly against each other. I can find a combination of those two that would give me a risk-free return, which is why we would absolutely love to be able to find these types of investments, right? But normally it's going to be somewhere in between there. And you see here, this shape, it's sort of like the arc of a boomerang. If you've ever seen somebody throw one and it goes up and it arcs and it comes back, that type of curve. And so where we're going to be on this is 60% Southwest, 40% Amazon, right? So we're closer to Southwest, right? But you wouldn't want to go, below this point where the furthest end, right? All of these areas here, you may as well take this point because it's lower risk and it's higher return, right? But once we're above that inflection point there, that's the portfolio with the lowest variance is what we call it. But once you get to that point, where you are up here depends on your appetite, right? I want this much, I need a 14% return. Okay, sir, you need 80% Southwest or whatever that point would be, right? But you understand by doing that, now you're taking on this level of risk, right? Where if you were willing to take the 13, you would have had this much less risk. So you're taking on this much more risk for 1% more return. And that may be okay for you, right? Everybody has their own preferences. Some people are very aggressive investors. Some people are very conservative. Okay. So if you take that though, from the lowest return or the lowest risk, that's that lowest variance portfolio, that's where A is, right? That right there is the one that you want to invest in if you are the most risk averse, right? but people willing to take on more risks, such as B right here on the line, or all the way up here to C on the line, you can get higher returns because you're taking on more and more risk. Now, you can definitely invest in these little spots down here. And in fact, most investments are down there, right? Because what Markowitz said was, look, there's this one like line all the way out there that we're all trying to get to. We're trying to push ourselves to lower risk and higher returns so that we reach the edge. It's impossible to be up here, right? Right. And so, I mean, let's jump ahead a little bit. I'm sorry. And so we're just trying to push here. This stuff would be impossible. I can't get a very safe investment and get a 20% return in this market, right? Like that's just not possible. So we call this actually the efficient frontier, because it's that border, it's the edge. Okay. Now we're going to introduce something else called this a security market line, and you have to understand what we're going to be allowed to do in that case is we can lend money, and what that means is go and buy U.S. treasuries, because what you're doing is you're lending money to the federal government, right? That's what the bond is, right? And so I can do that, right? And I could go all the way to buying just bonds, again, the risk-free rate, right? That would be 100% bonds, right? Or I could have some other percentage between bonds and that efficient portfolio, right? Or if I can get a margin account, I can borrow money and invest even more. And that's how people start getting those outsized returns, right? Because this is what we refer to as leverage, right? So I'm able to sort of bend this line straight because of being able to borrow and lend. But this is assuming I can borrow at the risk-free rate. Now, if this line, if you're not able to, which is how it works in the real world, then this line is actually bent, right? And it bends back, onto this because you're not able to borrow that way. But assuming you could both lend and borrow at this same rate, right? Then you would be able to be anywhere along that line. Right. And so here's an example of a portfolio. You see the correlation is really low. It's close to zero, right? The standard deviation of that portfolio, right, is 15.9, right? And then you could compare that, to, what these are individual, like without if the correlation was 1, it would be 20.3. Standard deviation is only 15.9, and our return is 12.3, right? So taking that, right, if we have the correlation now at 0.4, right, you would think, okay, well, we can just add that up and get the standard deviation. No, that's not it. We've done this, but this is how, again, you remember we calculate that. We say, okay, it's the weight squared times the variance plus the other weight squared times this variance plus 2 times, the weights and the covariance, right? Or correlation and the standard deviations, right? And so this is, again, just trying to explain the benefit, even with, that is higher, obviously, in this case. The earlier example, 15.9, because the correlation was so low. This one, the correlation is 28.1, but it's still less than the 33.6, right? Okay. And so that difference, right? The new standard deviation of the portfolio with the correlation coefficient of 0.3, the new standard return, right? And again, if you look at this one with a correlation coefficient of 0.3 and those weights, right? My standard deviation is 23.43. It's safer than even the safer investment, right? And then my return is 18.2. That's higher than that investment. It's not quite as high as this one. You may prefer to just go buy this one if you're a really risky investor, right? But you can save 7 percentage points here in the standard deviation and only give up 0.8 in your return, right? Which is really good. So and so this is that diversification, right? So remember, we're always trying to go up and to the left, right? We want to be higher return, lower risk, right? And when we're talking about the returns that we're getting based on that level of risk, then we need to talk about the Sharpe ratio, right? And so what that is doing is saying, okay, what was my return, right? What did I actually get minus what that risk-free rate was? So what was my excess return? And then divide that by the standard deviation, right? Did I have to take on a lot of risk to get that particular return, right? So somebody could say, yeah, man, I got 20%, but then you do a Sharpe ratio and you're just like, yeah, but you should have just gotten 14% and you would have been so, twice as safe, your return would have been much better, right? And so that Sharpe ratio is normally how we're going to compare between various investments because we want to adjust for the risk. Okay. So we have a market portfolio. Remember that we said it's the beta is 1 and it gives you the return on the market. We know there's a risk-free rate and then there's this security market line that connects those, right? And so this is our relationship between risk and return, right? Going from 0 to 1 beta, right? Goes from the risk-free to the market rate. This is the market premium, right? Remember the return of the market minus the risk-free was the market premium, right? So it's a rise of the market premium and then a run of 1, right? If you remember the slope of the line is rise over run, right? And so that's the rise, the market premium, and then the run is 1, right? The 1 beta. Okay. And so we're going to look at all of our various investments based on that, because we know that whatever return we have, right, on our investment minus the risk-free rate, because that part is given, should be equal to whatever our beta is times the market risk premium, right? So if we're the same riskiness as the market, if beta is 1, then we should get the return on the market, right? If beta is 2, we don't get 2 times the market because you got to remember that 2 gets carried over here as well, right? So we do have to account for that risk-free. It's not as simple as just, beta times that return. We got to incorporate the risk-free. And that is where we come in with the capital asset pricing model, right? The Capm. Okay. So starting with this, right, we have our T-bills and our market portfolio. We can invest anywhere along the line here by lending money to the government, right? Or if we can borrow money at the risk-free rate, then we can invest up here. Okay. And in equilibrium, right, because we talk about dynamic equilibrium, right, then stocks would tend to get to whatever the security market line is, right? Because you wouldn't want to buy stock A on its own, right? What you would do is you would say, okay, this, given the return here, I would prefer risk-free, right? So I'm going to lend the money and then just put the rest of it in the market portfolio, and I can be somewhere on this line, right? And then for stock B, what you would do is just borrow money, and then again, you could be back up here on this line, right? And so in equilibrium, you're going to tend towards that line, right? But how long does it take to get to equilibrium, right? Well, let's just look at it, over time, right? This is looking from the crash for the Great Depression all the way up to before COVID. Before, or it's a couple of years before, but it's a pretty wide span, right? World War II is in there, the fall of communism. I mean, there's so many changes, right? And if you look in that case, okay, it's not exactly that. But then there was a lot that happened, right? And a lot of this with Capm came about in the 60s, right? So if you just look at, say, that time period, maybe they were looking at something special. It is a little bit steeper, like it does fit that line a bit better, right? But what about the time period since it was published, right? Well, it's actually gotten worse. And in fact, if you see how it curves down, that should not happen, right, under our model. But again, you're catching a lot of things because those are higher beta portfolios. And so is that the .com maybe? I'm not sure, but there's so many changes that happen. It's really hard to talk about it in quite that way, right? So there's probably, we would say, some other things going on, right? Maybe that one comparison to just the market as a whole isn't enough, right? So that was the basis for that Capm model, the security market line. But given that the data doesn't really fit, it's like, okay, this isn't the best model, right? So what else could we do? And not to belabor the point, but just jump to the punchline, right? The two factors that they tried adding to see how this worked was looking at the market, the book to market value, right? So if from accounting, we had machinery we bought and then we depreciated it, and so the book value of the machine could be zero, right? We could completely depreciate the machine. However, that machine still has market value, right? And so looking at book to market, that ratio, if you take the high firms and then you subtract from that the low firms, then you see how there's this excess return that occurs, right? High minus low, and you see how it changes over time, right? And then same thing with market cap, right? So small firms, right, tend to be your big growth firms, right? The startups and that type of thing. And so small minus big, right? When we're saying high minus low for book to market, this is basically the company's value in the market's really close to the value of the assets, right? That's what high means in that case, right? And low would mean there's a lot of sort of speculation in the market, right? You look at on paper, the company's worth 2 billion, you go to the market and it's worth 12 billion, right? That would be the difference, right? Where the small minus big, like I said, that's like the small firms return minus the large firms. And so those are the two that have been best. So if we want to incorporate that in, then what we use is something known as arbitrage pricing theory, APT. So there's Capm, this is APT. And the difference is basically, instead of just saying beta, we use a lowercase beta, but we use subscripts, and then you can have however many factors you want, right? And then there is some noise, right? When you write this out, we normally write a lowercase epsilon, which is kind of like a curly E, just to say there is also going to be some noise. Not every factor is accounted for, right? And then the alpha here is an excess return. And so what we would do then is we'll have all of these factors defined, such as high minus low and small minus big, right? As well as the market, right? And then from each of those, you would subtract off the risk-free, right? Instead of just the one, you'd have to subtract it off all three, right? And then multiply it by those small betas. Okay. And this is just looking at different other factors, right? Because I was just using three. These are some that people have used: interest rates, exchange rates, what's the inflation, and so based on each of those over that time, they were able to calculate. Each of them sort of had this kind of risk premium, right? And so then we can use that and their returns with a whole set of data, right? This would be across a large sample. Then you can start estimating what each of those beta terms would be. So this is how important yield spread is. I mean, it's one thing to say this is how much the premium is, but how much weight do we put on that, right? And that changes over time as well, right? So we're not going to do anything quite this complex. I just wanted you to be aware of this, right? What I'm talking about is something known as a three-factor model. And I already told you the three factors that I thought I had a slide, but yeah, so the three factors, like the high minus low or the small minus big, and then market, or you can look at something else, like because you're a particular industry or something, there could be lumber sales and new home starts might be correlated with a particular thing or something. So you would go and look at what would be a good predictor. There's a whole branch of finance that actually looks for those kinds of things. So, excuse me. All right. So this next piece I just want to move into is we're going to talk about projects now, right? And in our case in the class, that's what we were looking at is this possible project, right? And so my job as the manager of a firm is to take on all projects which will maximize the value for the shareholders, right? I'm supposed to take on projects that grow the firm, right? And the way I can do that is by calculating the net present value of all these future cash flows, right? And so the value of the firm itself is basically what is the value of all of these assets that I have, right? That would be the value of the firm. It's not the book value, right? I'm not saying like it's the present value of that. It's of the value of these assets based upon the return that you get from those assets, right? But yeah, so you can just add up all of the parts of the company, and that's the company, right? Is what this is saying. Okay, and so here's an example using a company. So their cost of capital is 7.7%. And but the beta of J&J is 0.81, right? So it's safer than the market, right? The market is a beta of 1, right? And so I would only discount at 7.7 if the project itself was that same level of riskiness, like a beta of 0.81, right? If it is a lower beta project, it's a safer project, a more guaranteed project, right? I would use a lower rate, right? Because I would go along the security market line to whatever that required return was, right? If let's say the beta was 1, and now I'm up here, I got to discount it like the market rate, what's the rate that the market gets, because that's what a beta of 1 is, right? So so that's how we'll calculate the cost of capital for the project. It's looking at the project relative to the beta of that firm. Okay, and so here's looking at debt and equity, right? Because that's what makes up our capital, right? And so the required return on the assets, that's what this R assets is equal to the cost of capital, right? COC, right? Cost of capital. And what is our cost of capital? It's whatever we have to pay on debt times the percentage that's debt, and whatever we have to pay on equity times the percentage that's equity, right? These are market values though, not book values. Okay, so the market value of equity, because that's all I have, and the market value of debt, and that's what it would go for in the market today, and then the market value of the firm, right? And then the required return on debt, right? This is my yield to maturity that I have to pay, right? So if I issue a bond, what's that interest rate, right? That's what the debt piece would be, right? And then the equity is what does my investor require of me, right? Do they require 14% or do they require 10%, right? And that's the same formula we had used before. The beta of this particular project, right? You see it's a B, right? We're trying to separate out, right? It's not the same beta that we were talking about with the market. It's like the based on this particular project's riskiness, right? Times that market risk premium, right? And then we add back the risk-free rate. And that's what our investors would require. Okay. And so, and then those of you that saw the other video, we talked about weighted average cost of capital, right? And it's the weights of the equity and the debt, right? And the required returns of the equity of the debt. And I said, and don't forget, we also have the tax shield, right? Where what I pay on debt after taxes is even less than what I stated that I paid, right? Because I get to write off the interest expense, right? And so based on that, I can come up with what the weighted average cost of capital is for the firm as a whole, right? So let's talk a bit more about the cost of equity, right? And where beta, comes in there, right? And so when we talk about debt and equity, you've heard me say capital structure a lot. All that is just the mix of debt to equity. 50% debt, 50% equity, 20% debt, 80% equity, whatever that is. That mix between the two is the capital structure. Okay. If you want to expand Capm to include that capital structure, right, that's where we can come up with, this was our Capm model, right? And so we can just say, okay, well, the required return on equity, right, is just equal to that a beta type term, right, for this project, right? But we have to estimate that beta, which would be different than just, we can just go to the market, because I'm looking at a project, it's not publicly traded. I can't go look at what the returns are relative to the market, right? So the security market line, again, remember it shows the return, risk and return, right? And the Capm used beta. We showed arbitrage pricing. I could put in a whole bunch of betas, right? All those lowercase ones, we looked at 3-factor, right? And those things. But just using the Capm and to calculate the security market line, we can also use, other methods, and I'm going to show you one of those as well. Okay. And this is just to show the correlation between the returns for US Steel and then the standard deviation, right? So the risk and the return over all these different, I don't know if those are quarters or no, it's probably like months, I guess, right? And you see 2008 through 2012, and then 2013, 2015, you see how the shifted, right? The 2008 through 2012 was during the financial crisis, the home building, and all that. And then 13 through 17, it's a slightly different environment, so the beta itself is changing, but the other thing to keep in mind though is if you see this thing called R squared, is how well does this explain it? From 2008 2012, it did a really good job, right? The R squared is 0.56, 1.0 is impossible, right? Like that's what it tends towards if you can add enough terms, right? And it's just a lot more noisy here, right? So I don't know if that has to do with steel production move to China or something. I don't know, but you can just see it explains a lot less, right? And that can happen over time, right? Here's Microsoft, right? Again, it used to explain a lot better 2008, 2012, and then the things are different, right? Beta didn't change much, but again, the explanatory power really dropped, right? This is Con Ed, Consolidated Edison. So if you ever, you watch those TV shows set in New York and they'll talk about Con Ed, that's who this is. You see there, it's really flat. I mean, they're a highly regulated utility. And so you don't see much correlation, right? It's just kind of like, oh, there's something. I mean, the returns are really fixed, right? Based on government legislation, right? Or regulation, right? Because they're a power company, right? Energy company. Okay. And so just as we had talked about, beta, the project, we can talk about beta of assets, right? And so when we're calculating a company's own cost of capital, right, we're not saying the beta of the market itself, we're saying the beta of the assets, right? And then that's based on, the debt and equity piece weighted by debt and equity. That's going to be our recurring theme with cost of capital. We got to make sure we understand that debt and equity are a bit different, right? And in doing that, we can come up with this operating leverage. So whenever we talk about leverage, this is something that gives you a bit of an outsized return, right? Earlier I had talked about, fixed costs versus variable costs. And so that's what this piece is picking up on, like the mix between like basically capital and labor, right? If you think back to being structured that way. And then the assets themselves, right? What are they worth? And all of these, are based on the present value of that revenue stream, right? And that's going to give us the beta of the revenue portion, because revenue, is going to be, did I make enough to cover the fixed and variable costs, right? The present value of fixed and the present value of variable, right? And then I've got the asset itself. Okay. And so there's a couple of different ways to write this. This is like rearranging the terms, right? And so if you see here, present value of revenue minus the variable cost, right, divided by asset, or 1 plus the present value of the fixed cost over the asset. So it may have been a while since you've done economics, but revenue is what you're getting in from sales. Then I pay my variable cost, which has a per unit, right, variable cost. So maybe I make $10 per unit, but cost of goods sold is $6 per unit. That's a variable cost. But then I have a fixed overhead of, $1 million, right? And so that's what we're getting at here, what revenue is used to pay for. And then, yeah, so, yeah, all right. So, but that would give us beta of the assets. This relationship between beta of the revenue, right, and beta of the asset. This is how that scales, right? And it's based on fixed versus variable, because that's how our assets are. Are we using more capital, which is fixed costs, versus variable costs, which are not? Those are either expensed or labor. Okay, so this goes back to our case, because we have the possibility of a bad outcome, right? So first we're going to do it with no bad outcomes, and then we'll introduce a bad outcome, right? And so project Z is going to produce one cash flow. It's going to be $1 million, and I get it in year 1. It's above average. It's average risk, right? Meaning discounted at 10%, right? And so the present value of an annuity, or not annuity, present value of a payment. This is a single payment. It's $1 million, right? $1 million in a year at 10% is worth $909,000 today, right? Okay. Now, what if we introduce risk in the sense that it's not $1 million, there's a 50% chance it's $1 million, right? But there's a 25% chance it's only 800,000, and it's only a 25% chance it's 1.2 million. Well, turns out, right, when you multiply these together, right, 1.2 times 25.3, 1 times 0.5 is 0.5, and 0.8 times 0.25 is 0.2, and you add those up, it's 1, 1.0 times 1 million, so the 1 million, right? So even though there's some risk there, the expected value, or what we say unbiased forecast, right? No weighted or anything, is 1 million. That's the average value right here. Okay. But what if we change all that? We reduce all these by 10%. So instead of 50, this is now 45. Instead of 25, this is 22.5, right? So we take the 10% off, and there's a 10% chance you get nothing, right? So again, we multiply it out, right? 1.2 million times the 0.225, right? 1 million times 0.45, 800,000 times the 0.225 again, and then 0 times anything is 0, right? You add it up, and okay, well, it's actually only going to be 90% of the 1 million, right? Or 900,000, right? And if I do the same type of calculation, instead of the 909, it's like, oh, no, it's only going to be 818. Okay, so we can introduce that in and then use that forecast, right? I'm going to show you another way before we end today, right? And so this is, they call it correcting for optimistic forecast. Salespeople are always really confident, right? That's what makes them really good salespeople. And because they're really confident, sometimes they're a little overconfident, right? And so You know, in our case, right, let's just say we had a whole bunch of $1 million, you know, this is, or this is 1,000, but you know, like cash flows, but we're only getting 90% of that, right? Well, the present value of $1,000, right, at 12% is 892, right? Of $900, it's only 803, right? Okay. So if I look at the difference, right, between those two, right, what's the present value of that corrected amount, right? The 1,000 to the 900, right? All of that's 10%, right? Okay. So I was going to discount at 12%. I know I'm going to be 10% off, right? If I discounted that at 22% instead, right, then I end up getting 819 here, which is higher, right? But because I'm discounting at a higher rate, if you look further back, right, it gets to be, you know, significantly different, right? Because these future cash flows, because the discount rate is so much higher, right? The present value is so much lower. And we can say, you know, one year we did it, right? And you saw the calculation, how we came up with, you know, the $818,000 would be the correct present value. But if the thing goes far into the future, you see, you know, that present value correction can get to be pretty big over large timescales, right? And so there's another way that we can look at doing this, and that's to look at it as a certainty equivalent, right? And so instead of saying, okay, I'm going to take the cash flow that I get and discount it at the discount rate, right? My discount rate, right? I'm going to take the certainty equivalent, the T-bill equivalent, right, of this, and then discount it at the risk-free rate. And those will be equal because that's how I define this certainty equivalent, right? And so in this one, I have risk, right? My R is bigger than RF, right? So there's a risk premium there. And if you notice this discounted at time T, right, there's also a time value of money, right? This one right here, though, is risk-free. So there is no risk term here. It's just the time value of money, right? Because I've pulled out the risk here to make this certainty equivalent, right? So it's kind of like there's two paths in the woods, right? And which one do you want to take? So the one that we normally think about, or I shouldn't say normally, the one that I've been telling you about up until this point, right, is this risk adjusted, right? I'm going to discount for time, right? Time value of money piece, but I'm also going to adjust for risk because I'm going to discount it at that 1 plus R, right? Down here, I could give you a haircut for risk, make the certainty equivalent, right, for your cash flow, and then just do the time value of money discount. I should come up with the same value because I'm capturing the risk. I'm just breaking the risk and the time value of money into two pieces, right? So I should end up coming up with the same value, but you can do one or the other based upon, you know, what you prefer, right? Okay. So here's an example. We'll go through this one, right? So this is certainty equivalent, right? Project A is going to give us 100 million for 3 years. It's got a risk-free rate of 6%. The market risk premium is 8%. The beta is 0.75. What's the present value? And so first we got to get what's our discount rate normally, right? So, you know, beta times the market risk premium, right? We got that plus the risk-free rate is 12%. Okay. So I'm getting $100 million cash flows in years 1, 2, and 3. If I discount that 1 year at 12%, I get 89. 2 years at 12%, 79. 3 years at 12% is 71. So I can say, okay, the present value for these future cash flows is $240 at that 12% discount rate. Okay. So starting with that $240 or 240 million, right? 240 million, $0.2, right? What if we make a T-bill, right? I'm going to go buy a portfolio of T-bills that could give me those present values, right? That would be the risk-free equivalent to those present values. Okay. And so take the same present values that we just, this is from the last one, right? So if I were to have those present values, right? I said, we were told the risk-free rate was 6%, right? So at 6%, 89.3, right? In 1 year will grow to 94.6. And then the 79.7 in 2 years would grow to 89.6. And the 71.2 in 3 years would grow to 84.2. Right. And so you notice the present value is the same because we're backing out, right? It's like we took the time value of money, we went around the top path, right, in our forest, right? And now we're going down the other way, right? So we're going to back out the time value of money piece, right? And then we're left with our certainty equivalents, right? So the certainty equivalent of 100 is this 94.6. Right? So because we end up getting that same value, right? 89.3 at 12% is 100, 89.3 at 6% is 94.6. So the risky is equivalent to that risk-free. Okay. So now that we have that, we can look at what is the difference, right? The difference between 100 and 94.6, the difference between 100 and 89.6, the difference between 100 and 84.8, right? Because that is the certain equivalent, right? I'm not going to get all of this because I'm not taking on any risk, right? And so the risk, right, 5.4, 10.4, 15.2, this is how much I have to, that haircut that it talked about, right? You take off a little haircut for risk. That's what this is. I have to make this deduction for risk. Okay. So since we have this difference, right, between 100 and 94.6 is 5.4%, what we could do is say, okay, we could take any of those risky cash flows, so year 2, year 3, and we're going to use that discount rate to give us the certainty equivalent cash flow for those steps as well. Right. So here's our last step. Right. So I take each of those cash flows, 100, 100, 100, right? Discount it back. Right. And look at that, 94.6, 89.6, 84.8. Right. Same ones we had before. Right. So, so again, we're always going to end up at the same place. It's just sort of how it's constructed. So I hope this helps. I hope that you find it useful, but please let me know anything else that I can share with you. Thank you.